Good morning, everyone. Welcome to our 567 Taxes and Retirement Workshop. Today's presenters are going to be Kim and Ann. We're having just a little bit of technical difficulties, so you can probably see Ann on your screen, Kim on your screen, and Ann will be joining us soon. You can probably hear her audio. Oh, there she is. All right, guys, enjoy your presentation.
Great. Good morning, everyone. This is Ann Newman. I'm here with Kim McMahill. I don't see my camera. Kim, is my camera working? Oh, no. Right. Well, it was working until about 1 minute ago, so I'm not sure.
There we go, Ann. You're good to go. We see you. Sorry, everyone, for our technical difficulties, but we're good to go.
Good. Well, thanks, everyone, for coming out and joining us. Sorry about that. I want to just thank you for coming, spending your time with us. We want to make it very informative for you. I want, as a just housekeeping item, to let you know that on the right side of your screen, there is a question and answer section. And if you can see us and hear us, please give us a shout out, give us a hello, and maybe tell us what city you're attending from in the comments. So if you can see my face and hear my voice, and if you can see my screen, say hello. We're going to dive right into our presentation, but let's warm up with a little tax brain teaser. This is a little question about a retiree named Bill. And after working hard for his adult life, Bill 65 has finally retired, and he's going to go to some more concerts than he ever has before. He has $42,475 in taxable income, which includes $25,000 of Social Security benefits this year. And as you can see, Bill's $42,775 puts him in the 22% tax bracket. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson. How much is he going to be taxed on that extra $1,000? Well, the logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income tax. Therefore, if he took out $1,000, he should owe $220 in federal income tax. 22% tax. Simple enough, right? Unfortunately, no. He owes $407 in tax, a 40.7% federal tax rate on that income. Because of the madness of our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. It doesn't make any sense, but here's the thing. Unfortunately, it's the tax code, and it doesn't have to. I'll explain more about why Bill faces this tax, but for now, the important thing is to realize that when it comes to taxes, the obvious answer isn't always the correct answer. So thank you and welcome to our presentation on Taxes and Retirement 567. My name again is Ann Newman. I work at SENB Bank in the Wealth Management Department. And Kim McMahill is here with us, and she is a very close colleague of mine, also here at the bank. From time to time, the two of us present workshops and classes on various financial education topics. We have a real commitment to doing that. And our goal is always to inform and educate so that you can make and understand the decisions that you're making and how critical financial planning topics affect you and your family. So we typically do in-person education events, many times at the Bettendorf Public Library. And one thing that's great about those presentations is that we get to stick around afterwards and answer everyone's questions. We're not going to have the opportunity to do that today, since, of course, we're doing this virtually, but we want to make sure you get all of your questions answered. So just like I mentioned before, type and take notes, and you can type into the question and answer section any questions that you have. That's completely private. The only people that we can see that are Kim and I, and we will follow up with each of you and make sure that your individual questions are answered and that there's nothing left outstanding when we're all done. I also want to mention that at the end of today's presentation, we'll invite you to have your own taxes and retirement planning overview meeting. It's completely complimentary, and it's where you can ask your questions in private on a one-on-one meeting. And I assure you that that's not a sales presentation. You'll hear nothing remotely close to a sales pitch. Educational, that's something that we want to offer to each and every one of you. Why am I doing this? Several years ago, my father-in-law decided to retire from farming and sold his farm and his family business. And there are some decisions that he could have made differently that would have saved really thousands of dollars in taxes in just the way that that was structured. So this is a picture of my family, and oh, I see we've got a poll that popped up. Are you currently retired? So we want to keep this interactive. So if you want to go ahead and answer that poll, go ahead and answers.
So my name is Kim McMahal. This is a picture of my crazy crew. We're a little bit of a blended family. I have 3 girls. My fiance has 3 boys, so we're like a real life Brady Bunch here of 8. My background has been in working in nonprofit as well as in insurance. And my real reason why is I remember sitting at the dining room table watching my family, my aunts and uncles fight over my grandmother's estate, and lots of yelling and not talking, and I just never want anybody else to have to go through a situation like that. So I love helping people to have a good plan so that they can have a nice cohesive family.
Thanks, Kim. And Kim's going to let us know when poll questions pop up. Hope you have fun with those. Kind of a fun little thing we'll do along the way. Everyone's tax situation is a little bit different, so don't forget, we want to encourage you to always talk with your personal tax advisor to discuss your specific situation. Regarding traditional IRAs, Roth IRAs, state taxes. I don't provide tax advice. What Kim and I both do is we help people understand how the tax code and other rules could impact their financial planning and their investments. And we help them make a plan to take those things into account. Our goal today is to help you understand what the retirement distribution game, spending assets in retirement, how that's much different than the accumulation phase when you're saving for retirement.
It looks like I have another polling question, Anne.
Oh, thank you. Do you believe taxes will go up in the future? Give a couple seconds for everyone to do that. Chances are that you've been in the accumulation phase of your life for quite a while, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now as you enter prepare to retire, whether you answer the poll that you're currently in retirement or you're thinking about retirement, phases change, and the planning that goes along with those phases will be different. And the distribution phase has new and sometimes strange rules that can catch people off guard. And along with those new rules, there are often many changes in your personal life that can have a big impact on your taxes too. For instance, your children may be grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. And if you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. And if you've stopped working, you may no longer have the ability to put away income in a 401k or a similar plan to manage your annual tax bill. And at some point, you'll start taking Social Security. And sooner or later, when you reach 72, you'll have to start taking required distributions from your retirement accounts. The list goes on, and many aspects of retirement will affect your tax bill in ways totally different from your working years. So our goal today is to help understand what these changes in life are and how they can impact you, and it can be absolutely critical. So that brings us to a simple statement about what we're here to talk about today. And simply put, people often pay more taxes in retirement than expected because of a confusing system which treats different types of income differently and contains some hidden taxes and penalties. So in the accumulation phase, people build their assets in several different ways. So your stocks, your bonds, real estate, pensions, 401ks, and IRAs. In the distribution phase, your regular wages stop coming in, and you have to take the money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. That's challenging because you need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. So in retirement, your tax rate can vary dramatically based on the decisions that you make, such as the timing and order in which you use different sources of money to pay for your expenses. Poor choices through a misunderstanding of the rules can result in people paying more than necessary. And as a result, they can see their savings drop faster, and that can mean less to leave to the kids and grandkids. Of course, we don't want that to be you, and the fact that you're here means to me that you're willing to work towards a solution, which is an important first step. Because your tax exposure will change throughout the 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges and penalties related to Social Security, Medicare, and other income sources. So that means you'll need an informed and proactive plan that addresses how you create your income in retirement. So my goal is to introduce you to the major aspects of such a strategy, show you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. The first step is to develop an understanding of the types of taxes you may face. And why do I mean taxes? I'm talking about all the costs that can increase as your income does, including some that aren't actually called a tax. To me, if your cost goes up as your income rises, it's a tax. And so you'll need to understand the retirement expenses you'll face, and you'll need to create a strategy that will help you decide which of these taxes affects your assets and which assets to tap first. So let's go through those 4 stages of retirement. These are rough ranges and descriptions. Everyone's experiences vary. This is just a framework for discussing this topic. First, there's the pre-retirement or the final work as you save years, generally between ages 50 and 60. Next, the early years of retirement, 60 to 70, we're going to call those the go-go years. People often have really fun plans for this time. Traveling, volunteering, starting new hobbies, maybe working part-time, spending more time with friends and family. Next, you reach the middle years of retirement, 70 to 80, maybe the ghost lower years, which bring more financial decisions such as how to deal with required minimum distributions from your IRAs and your other retirement accounts. And finally, there's the later years of retirement when your health may not be as good and you're thinking about your legacy and estate, the no-go years, starting around age 80. As you can see, there's a wide range of issues, and we're going to plan for each phase, and it can be sometimes a little bit more difficult than it seems because retirement's full of surprises, and even the best planning will divert from reality at some point. One future unknown is inflation. People tend to view their future costs in current dollars and don't always anticipate how those costs grow with inflation. Or how about all of our longevity? Many people end up living far longer than they expected, and that requires more money at a time when it's difficult to work. How long do you think you'll live? Many people also underestimate how much money they'll need to maintain a pre-retirement standard of living, and who wants to see their standard of living drop. And then there's the healthcare costs, the 10,000-pound gorilla. This includes your out-of-pocket payments for services and drugs, plus Medicare insurance costs, which keep rising. So at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here's the first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. Oh, I see we have another poll question popped up. What's currently your greatest concern regarding the retirement assets and plans? Is it losing money in the stock market? Running out of money in retirement? Paying too much in taxes? Obviously, the higher your tax rate in retirement, the less your retirement accounts are actually worth. Now, I want to note that required minimum distributions have been suspended for this year, for 2020, as part of the CARES Act. So if you're turning 72 this year, you won't have to worry about your first distribution. And really, all distributions that are required from IRAs in the year 2020 have been put on hold. We hope things go back to normal next year, and of course, required minimum distributions will begin again in 2021. Here's a chart that shows the cumulative after-tax amounts you could expect to receive from a $500,000 IRA that earns 6% a year at various tax rates. And you can see the lower your tax rate, the more you keep. Simple in theory, but difficult in practice. But you might be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when creating your retirement strategy is that Social Security and Medicare have their own tax traps, and you need to plan for them too. So let's talk about Social Security and taxes. Now let's go back to Bill from our brain teaser when we first started. And we want to understand why he paid such a high tax rate on the extra money he took from his IRA to go on the concert road trip. Remember, Bill has $38,000 of IRA income as part of his adjusted gross income of a little over $56,000. And he has $25,000 of Social Security benefits. That puts him squarely in the 22% tax bracket, and he takes a standard deduction. Yet when he took out that extra $1,000 IRA distribution, he got hit with nearly a 41% tax rate, or $407 of tax on that $1,000 distribution. So let's break down how this actually happened. And let's remember, the only difference between the two scenarios is that Bill has taken an extra $1,000 out of his IRA. So we see on this next slide that by adding that additional $1,000 of income, it increased both his adjusted gross income and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. Well, how is that? Here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all your Social Security benefits will be income tax free at the federal level. But on the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. So Bill finds himself in the latter scenario. And at his current income tax, the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must add 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. So if you do the math on that, it comes out to 40.7% real tax rate on the additional $1,000 of income. And that's the so-called Social Security tax torpedo. And it can impact single filers and married couples with fairly modest income during any stage of retirement. And it's one reason that planning taxes in retirement is so important. So let's look at another aspect of Social Security and taxation and how people approach retirement. Now, during the go-go years, when some people retire altogether, but other people enter into a sort of semi-retirement. Sometimes it's a continuation of a previous job with just fewer hours. Others use semi-retirement to explore an interest in a new field. And some people pursue non-paid, rewarding volunteer work. So working retirement can impact your planning and taxes in a number of ways, some good, some bad, and some kind of ugly. So let's look at working during these years. And that can be a great thing. Chances are you've researched what your Social Security benefit might look like at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of inflation-adjusted earnings. Well, what if you started working later in life? Or what if you left work to raise children like I did? You may not have 35 years of earnings history. Suppose you only have 28. The remaining 7 years count as big fat zeros when they calculate your benefits. But there's good news. Earnings at any age can help you increase your Social Security benefit. And that's thanks to how Social Security calculates your benefits. Replacing several years of zeros with even modest earnings can positively impact your benefits. And now let's look at how working during your go-go years can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limits that applies prior to reaching your full retirement age. And here's how that rule works. If you start Social Security, be it on your own retirement benefit or your spousal benefits, prior to the year you reach full retirement age, for every $2 above a certain amount that you earn, which is $18,240 this year in 2020, Social Security will withhold $1 of benefits. Keep in mind that we're talking about earnings here, like a W-2 salary or self-employment income, not pensions, interest, dividends, or capital gains. They don't count and won't reduce early Social Security benefits. So for instance, let's say that you earn $20,240 this year. That's $2,000 over the limit. Therefore, under the $1 withheld for $2 earning rule, Social Security would withhold $1,000 of your 2020 benefits. But these benefits aren't truly lost. When you do turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those withheld benefits. In other words, your benefit going forward will be a bit higher. And also in the year you reach full retirement age, there's a separate higher earning limit. So we've talked about the good and the bad, so now you get the ugly. We're here today to talk about taxes in retirement, but there are other taxes that you may face too. So for instance, when you're working, you're subject to the Social Security and Medicare taxes, in addition to income tax. And the self-employed pay twice that amount to cover the employer's contribution. Now, these taxes don't go away if you're working past your full retirement age, or even if you're collecting Social Security. A little bit worse, if your go-go year earnings don't make it into your top 35 years, these Social Security taxes go into the Social Security Trust Fund and don't increase your benefit. Let's spend some time talking about Medicare and taxes. And this is really where, when my father-in-law sold his farm, he didn't understand how this was going to impact the payments that he made for Medicare. Medicare and something called IRMAA can impact some couples, not only in the go-go years, but beyond. So what that stands for is income-related monthly adjustment amount. And the emphasis is on income because it's a monthly tiered surcharge, a kind of tax, that's taxed onto people's Medicare Part B and D premiums, but it only happens if you have income over $87,000 for singles and $174,000 for married couples. So let's take a look at what this means in action. So in our example, let's meet George and Martha. They're a high-earning married couple, and both are on Medicare Part B and D participants. IRMAA surcharges affect income from 2 years prior, and this couple was on track for $271,500 of modified adjusted gross income in 2018. But on December 1st, George decided to sell some stock that he bought for $10,000. He sold the stock for $11,000, and the resulting $1,000 in gain was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. So George and Martha owe $188 of tax on the gain from their sale of the stock. Or do they? Remember, my definition of tax is any cost that increases your income as your income increases. So then George and Martha will owe more tax than $188 because the gain from the sale of that stock pushed them off the Medicare IRMAA cliff into paying higher Medicare premiums. And let's take a look at that. Look at this Part B chart. The extra $1,000 gain pushed their adjusted gross income into the next premium tier that starts at $272,001. So now instead of owing $289.20 each for their monthly Medicare Part B premiums, George and Martha will each owe $376 per month an extra $86.80 times 2 for an annual total income-related monthly adjusted Medicare Part B premium of $2,083. But it's not over, because Medicare Part D changes are also impacted. And George and Martha will each owe another $19 per month for their drug plans, an extra $461 for the couple over the course of a year. So adding all of those surcharges together for the year, George and Martha will each owe about $100 extra a month, or $2,500 for the year. So now combine that amount with the $188 of actual federal tax that they would owe on their stock sale, and the total tax owed on that $1,000 of gain comes to $2,732, and that's a tax rate of 273%. So you can see being pushed into that higher Medicare Part B and D premium range is worse than being pushed into a higher tax bracket. And that's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. And it doesn't matter if you exceed the limit by $1 or $10,000. And that's why they call it the IRMAA cliff. And keep in mind that those payments aren't determined by how much you made the previous year, but rather from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision as well. And if it's not done correctly, you could get hit by a lifelong penalty. So to help you understand, in our example, we're going to use Jim and Ann, both age 68. Jim retired at age 65 and Ann retired at 66. And prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondarily to Medicare after retirement. But Jim and Ann didn't realize that mistake until it was too late. And thanks to the way that Medicare enrollment periods work, they weren't able to begin coverage until the next year. So in a worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had had a major medical need. But even in the best case scenario, because Jim and Ann missed their deadline to sign up, they'll each owe a 10% Medicare Part B base premium penalty for life. So you can see how that translates into real dollars. They owe $347 extra in 2020. And historically, we can estimate that premiums will be higher. So that 10% penalty will grow and grow. And over the course of the lifetime, it could translate into a $10,000 mistake for the couple. So we've seen how Social Security and Medicare can have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you may be asking yourself, wow, are there other tax traps that we'll face in retirement? Well, the rest of what we'll cover isn't like what we've seen with Social Security tax torpedo or the Medicare cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to the third key. You must know how and when to use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets effectively.
It looks like, Ann, we have another poll.
Oh, wonderful. What
age do you begin RMDs? 70, 70 and a half, or 72?
So I'm going to answer that there. And of course, the answer is that the IRS did change that from 70.5 now to 72. So we need to take a look at which accounts to spend first. Here's a common example, and we're going to use Sam and Mary. They've been good savers and are looking forward to spending their retirement years traveling and seeing their grandchildren. And in addition to Social Security, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, and $300,000 in a joint bank account. And they want to spend about $8,500 a month, or just over $100,000 a year. So where would you take the money first? Most people think first take the money out of the after-tax savings in the bank, then take the tax-deferred IRA money, and then take the tax-free Roth money. This is the conventional wisdom, and it's been promoted by investment firms for some time. It's not a bad plan, but we know conventional wisdom isn't always the best approach. So not surprisingly, this topic has drawn the attention of a lot of researchers specializing in financial planning, and they've conducted many studies on how to prepare for retirement using a combination of Social Security, taxable bank accounts, and tax-deferred accounts like IRAs and pensions. You can see some study titles here, and the research has shown that the conventional wisdom approach probably isn't ideal. So here in an alternative approach, there are two key elements in the early years. First, use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during otherwise low income years, putting that money into Roth accounts. This is the filling your tax bucket approach, which we'll discuss in just a minute. And this alternative approach gives you more flexibility to use that tax-free Roth money strategically in future years. Does it make a big difference? I certainly think so. And in the academic studies, this approach has been shown to increase portfolio longevity by about a couple of years. The big takeaway here is that you've got to plan all the way through retirement, especially around how you handle your tax-deferred assets. One way to help manage your income both before and during retirement is to utilize those Roth IRA conversions.
It looks like we do have another question.
Ooh.
Whether or not you do have an IRA, a Roth IRA.
We'll give you a second to answer that. A Roth IRA conversion is a process that allows you to move money from your traditional IRA or other retirement account like a 401k into a Roth. The amount that you convert is added to your income for the year and will be taxed. So let me give you an example. If Jill converts $100,000 from her IRA to a Roth, she'll have to pay $100,000 to her income, and the conversion income will be taxed at her rate. So it's important to talk with your tax professional before you implement this strategy. But a conversion doesn't have to be all or nothing. And one helpful conversion approach is called filling up the bracket. Often you might find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher bracket. So for example, in 2020, the 22% tax bracket for a married couple filing a joint return goes from $80,000 to about $170,000. And if you file a joint return and your taxable income is $100,000, that means you could add another $70,000 of income without going into the next bracket. So making a Roth IRA conversion like that would make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. Roth IRA conversions can be especially powerful in years when your taxable income's low, such as having a high non-recurring medical expense deduction or a low sales year for a business owner. It's also common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. They may have a very low tax bracket, making it a good time to complete a Roth IRA conversion in those pre-RMD gap years. You must know whether you're trying to keep income below a bracket threshold to avoid bumping up to the next highest tax rate, or whether you're trying to increase income to fill up a bracket to take advantage of that tax rate. Some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling high appreciated stock for low or no capital gains, or taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets.
It looks like we actually have another question, is would you like to de-tax your investments?
I'm definitely going to say yes on that one.
Me too.
There are two other pre-retirement strategies to consider, but they're not going to apply to everyone. And the first has to do with how you use a health savings account, and this would only apply to people who are covered by a high deductible health plan. And the second has to do with high earning small business owners who fund company pension plans and become eligible under the new tax laws for something known as the qualified business income or QBI deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits through retirement. If either of these apply to you, go ahead and note that in the question and answer section, and I can discuss it with you later. There are charitable giving strategies that can make your giving also very tax efficient for you. Because once you're over 72, you're forced to take out required minimum distributions or RMDs, except this year. We know that there's that exception. But many people make charitable donations supporting their favorite non-for-profit with annual gifts. So let's look now at how your required minimum distributions or RMDs and charitable giving can work for you with some planning. So in this example, we're using Albert and Shirley, who are in the 24% tax bracket. Now the standard deduction for them as a married couple is $24,800, but Albert and Shirley are over 65, so they get an additional standard deduction, bringing their total for 2020 to roughly $27,400. This means they'll not get any tax benefit for any itemized deductions unless they exceed that amount. So if Albert and Shirley have $15,000 of itemized deductions, that's not going to help them tax-wise if they donate $5,000 to charity. They get no tax benefit from making the charitable contribution because it doesn't exceed their standard deduction. That's not to say they shouldn't do it. It's just that they should understand it's not helping them save taxes. But if you're over 70 and a half and have an IRA or an inherited IRA, there's another way to give to charity than simply writing a check, and it's called a qualified charitable distribution, or QCD for short. And let me explain how that works and how it can be really powerful. So if you're over 70 and a half, you can make this qualified charitable contribution of up to $100,000 each year from your IRA. Any qualified charitable distribution you make counts towards satisfying your personal required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from the IRA to the qualified charity, or you can receive a check from your IRA custodian made payable to the charity. And even though you gave to charity, you get no income tax deduction. Why? Because when you made the qualified charitable distribution, the distribution from your IRA is never even counted as income when you compute your taxes. So let's see how this helps Shirley and Albert. So first, let's suppose Albert and Shirley do what many retirees do, and Albert takes his RMD of $5,000 at the beginning of the year and puts it into his checking or savings account. Now, being charitable people, they donate $5,000 over the course of the year to their charity. But by virtue of doing it that way, it's cost them $6,200. Why? Because that RMD went into their checking account and it has a tax cost. Remember, they were in the 24% tax bracket? So 24% times 5,000 equals $1,200, and the $1,200 of additional tax they must pay when they file their taxes means the total cost of their charitable gift is $6,200. Remember, the gift didn't impact their standard deduction, so the RMD on the gift got added to their income. But if they had had that $5,000 distributed directly from their IRA, instead of going into their bank account first, then the charity would have received the $5,000, and the couple would have received a $1,200 savings over the previous example because it's never subject to income tax on their return. It's one of the most widely used tax savings that I do with my clients, and I love that we can do that out of IRAs to help a lot of charities and also help reduce tax bills. So I hope some of the things that you're learning are helping, and this leads us to key 4 and talking about organizing assets for your family's benefit for estate planning. So the federal estate tax doesn't affect many of us anymore. It only taxes estates valued over $11.4 million. But there's still some important tax issues that remain about how assets are left to beneficiaries. And one of those includes the step-up in basis rules. And simply put, step-up in basis is a tax rule that readjusts the value of inherited assets. So its value is not what your spouse or your descendant paid for it initially. Instead, it's stepped up to the price on the date of death. And this can make a big tax difference, as we'll see. So in this example, let's use Phil and Mary. They're married and own a variety of taxable investments in a joint account. And the investments have a long-term capital gain of $120,000. One day, Phil's diagnosed with cancer and is told he only has 18 months to live. So let's see how this works with 2 different scenarios. In the first, Phil and Mary make no planning changes to their assets. When Phil passes away, Mary will receive a step up in basis on Phil's half of the joint account, which is $60,000. And she'll still face a future $60,000 in unrealized gains on her half of the account. So that means if Mary decides to sell the assets, she'll owe tax on her $60,000 of gain. But let's suppose that when Phil received the diagnosis, they moved all their investments into one account in Phil's name. Then as long as Phil lived longer than a year, Mary would receive a full step up in basis on the entire $120,000. So Mary could sell that account and pay no tax. So when you go to sell your investments, would you rather owe that $60,000 of gain or none? And let me say that planning around death is very hard. This is where talking with a professional can help, because they are emotionally removed from the situation and can assist you in making good decisions that may seem very, very hard at the time. And maybe you're someone who's managed to save up quite a bit in your IRA or your 401k, and you feel pretty comfortable in retirement and hopeful that you'll leave behind those assets to your children. In the past, we've recommended that because with the right structure, your heir could withdraw the money throughout his or her lifetimes, possibly decades. But that changed with the passage of the Secure Act. And now beneficiaries of inherited accounts, with some exceptions, must withdraw all of the money within 10 years of the owner's death. This restriction on what was called stretch IRAs shines a light on how important tax planning is. And laws can change at any time, so you need to have a plan and revisit the plan regularly. In our office, I tend to specialize in IRAs and estate planning. Well, Kim is really a specialty in trust planning and insurance. So at this point in time, I'm going to let Kim talk about some long-term care insurance issues that may impact many individuals.
Thanks, Anne. So, okay, enough about death. Let's talk about long-term care. This is not long-term care presentation, but it's about retirement and taxes. And believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums can be a deductible medical expense at the federal level and possibly eligible for deductions and credits at the state level of tax. And on the other side, if you are receiving long-term care benefits, in many cases, their benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefits policies are tax-free if they don't exceed the higher level of actual long-term care costs, or the IRS daily limit, currently at $380. Choosing how to pay for your long-term care can be a big impact on your estate and to your heirs. I'd like to help you get started with creating a retirement tax planning strategy. In a minute, I'll ask you to complete an evaluation for this presentation to help me with efforts in educating our community. During that, so sorry. I skipped over a slide here a little bit. In recent years, non-traditional long-term IRA policies that blend together some long-term care instructions of life insurance that have become popular. Often, the first inclination of the insured is here to tap into those policies to pay for long-term care costs, but are often a tax mistake. Let's take a look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly care cost is $60,000. Florence's Social Security benefits is $20,000. It's annual, which covers her basic expenses, not long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay up to $500,000 for Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for her long-term care costs. Any amounts unused in the long-term care will reduce the life insurance death benefit. Please note, just as an example, this is not meant to represent any specific type of policy, but many long-term and life insurance hybrid policies work very similar to this. First, suppose that Florence is informed infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? So here Florence pays a little to no income tax during the period because she has such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000 minus $60,000 for those 5 years. That means her kids will inherit a tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care expenses instead. Florence still pays minimal income tax for her year and a high medical expense deductions. Now the kids inherit $500,000 of life insurance and completely tax-free, as well as roughly $100,000 remaining of that IRA. Comparing these scenarios, it's the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care of $300,000 of taxable money with minimal cost to Florence is not better than the option of paying for her care of $300,000 of tax-free money. In the second scenario, we're presenting the tax-free money in their hair for her heirs, in which the long-term care with Florence taxable IRA money. Okay, we're getting towards the end, and you're probably thinking, goodness, how in the world can we manage this? And that's a good question, because that's what brings us all together.
Thank you, Kim. We started with a clear statement about the problem, and we've thrown a lot of numbers at you in a lot of scenarios. But it all comes down that retirees often pay more taxes than expected because of a confusing system that treats various types of income differently and contains some hidden taxes and penalties. So let's do a quick review on what we've learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years and low tax years. Then we looked at Social Security and taxes, plus the importance of couples having benefit strategy that considers the surviving spouse. And we saw Medicare has its own tax-like structure that can push you off the cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in your middle retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All of those items together led us to this obvious solution to our original problem. And that's because of your tax exposure will change throughout retirement years, you need a strategy that's going to anticipate how and when you tap assets to cover your personal expenses, understands the range of taxes you'll face at various stages, and manages your actions so you pay as low a tax or tax rate as possible.
And Anne, we did have a survey question of, are you confident your money will last you your lifetime?
That is the biggest question that we receive, and a worry that a lot of people facing retirement have on their minds. And just by attending today's presentation, you've really indicated that you're preparing to leave the accumulation phase, saving for retirement, and move on to the distribution phase, where you start spending those retirement assets. And we've seen that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge, and we've seen lots of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education and planning and advice. It's a lot to think about. Our tax code is complex and the rules keep changing. But what doesn't change is that you need a plan. So I hope you've learned a lot about taxes in retirement today. I realize that it was a really big commitment on your end to make it here today. And you took time out of your schedule and away from your commitments to work and to family. And because of that and the time you've given us, we really want to be of as most assistance to you as possible and help you from making mistakes and help you plan for retirement. So we're offering a consultation at our offices for you to personally ask your questions and receive a retirement and taxes analysis. So during this meeting, which we can do whichever way you're most comfortable, whether that is virtually the way we are now, via telephone, or in person wearing masks and social distancing, we want to offer that to you, and where we will help identify where you and your family stand in regard to preparing for retirement, review your timeline, identify key retirement planning and tax issues you need to anticipate. And this is a retirement and tax income analysis, and it's going to test your income sources prior to retirement to gauge if you'll run out before you're likely to pass away. So what this means and why this matters is that when you leave our office and when you have that completed analysis, you'll be able to rest easy with the knowledge that you're mathematically testing your strategy, and you can officially stop wondering if you'll outlive your money. So thank you so much for spending this hour with us. Unfortunately, we don't have time to take live questions and answers, but again, all of those questions that you type in to the question and answer section, we will get back to you personally with answers to those. And that's a commitment that we're making to all of you. So thank you again. We hope to see you some way, be it virtually or in person, to get that retirement and tax analysis done. And we thank you for joining us.